you. Good morning, everyone, and thank you for joining us on PI Industries Q2FY22 earnings conference call. Today, we are joined by senior members of the management team, including Mr. Mayank Singhal, Executive Vice Chairman and Managing Director, Dr. Raman Ramchandran, Managing Director and CEO, Mr. Rajnish Sarna, Joint Managing Director, Dr. KVS Ramrao, Executive Director, and Mr. Manikantan Vishwanathan, Chief Financial Officer. We will begin the call with key perspectives from Mr. Singhal. Thereafter, we will have Mr. Manikantan sharing his views on the financial performance of the company. After that, the forum will open question and answer session. Before we begin, I would like to underline that certain statements made on the conference call today may be forward-looking in nature, and a disclaimer to this effect has been shared in the investor presentation shared with you earlier. I would now like to request Mr. Singhal to share his perspectives with you. Thank you, and over to you, sir.
So thank you. And thank you and welcome to everyone. And once again, thank you for taking time out on the weekend for our discussions. Once again, my heartiest compliments to the ongoing festive seasons to all of you and your families. PI has delivered a healthy performance during Q2. Our revenue improved by 17%, EBITDA saw a 4% improvement, and our profit after tax saw a 6% when we see it against last year. On business front, our CSM exports continue to present an attractive runway of growth where we are scaling up existing molecules across our innovator relationships. Q2 recorded a 24% growth. We saw an overall growth of 27% in CSM exports year on year, as I saw the first one new MPP getting commissioned, whereas another MPP stated to be opened in the present quarter. We are looking at a target of 6 new commercializing during the year. Out of which 3 have already been commercialized in H1 22 and has been the trend. The funnel of inquiries and orders in hand have shown a good momentum in the underlying visibility of growth. On the domestic front, we could not be able to stem the decline despite global supply chain disruptions affecting imports and adverse weather events. In certain key geographies, further domestic operations saw healthy placements of new products ahead of the Rabi season, given late rains and adequate water levels at the reservoir. Growth is making an improving trend on back of high base last year, whereas we continue to show leadership in the rice herbicides, and we are seeing a momentum of our Kira adoption and scale up in the wheat herbicide segment as well. We are confidently moving ahead with a robust portfolio offering in the horticulture segment with Zivago. Measures taken to revamp the branding has been rolled out. Our team are specifically engaged in expecting farmer engagements via application services. These have been particularly tailored to utilize the latest technology and techniques of communication and communities. During the quarter, we signed a technology partnership under JV structure of biochemical space. The scale-up is expected to commence over the next 12 to 18 months. Our thrust on products research continues with 2 promising leads, but addressing a sizable potential. The initiatives to create a better process and scale of novel next-gen technologies has continued. We have, after intensive internal exercise, have developed the PI's new compass with defining a clear purpose, a purpose of reimagining a healthier planet, and also implementing a new operating model that enables us to accelerate the growth momentum in the current businesses, establishing new businesses, and also continuing to add new ideas, technology, and scientific discoveries. This will augment a drive to embark upon rapid, differentiated, organic and inorganic growth, which is resident of being ahead of scientifically and technologically. PI today is renowned and respected amongst innovators not only for the sharp emphasis on execution, but also the primary given its high corporate governance. Progress in our core objectives as we guide our intentions, we seek out to the right partners and assets to help achieve our goals. In the coming years, shall see an expanding of a footprint of addressing ability across the wider band of opportunities in the specialty chemicals. And before I end, I take a moment to reassure all our stakeholders that PI remains committed to delivering and driving a sustained growth performance throughout its existing scope of operations, while also outlining a strong presence in adjacencies, including pharma. Our experience and advanced technology platforms and digital backward integration for cost leadership at Generate IP continues to underscore immense potential. Our aspirations are unchanged, and we shall seek suitable and organic options to rapidly commercialize opportunities in the field of pharma. The termination of the DTA will not hinder us in any way. With that, I would like to now hand it over to our CEO, Manikantan, to share with you the highlights of the financial performance for the quarter and H1. Thank you. Over to you, Mani.
Thank you, Mike. Good morning, everyone, and thank you for joining us today. I'll be sharing financial performance of the company for the second quarter ended 30th September 2021. Please note that all the comparisons are on a year-on-year basis and on consolidated in nature. For Q2FY22, we demonstrated a strong revenue growth of 17% to 1,354 crores, steered by healthy expansion in export revenues by 24% to 993 crores, led by robust volume gains in key molecules. Domestic operations reported a moderate performance owing to global supply chain disruption impacting imports and adverse weather conditions in certain herbicide geographies, among others. Domestic revenues were at rupees 361 crore. Further, for the half-year ended 30th September 2021, the company has achieved a revenue of 2,548 crores, a growth of 15% on YoY basis. On profitability front, gross margin improved by 90 basis points in Q2 FY22, which came despite significant increase in input costs and reduced export incentives by approximately 1.5%. This expansion was supported by favorable product mix. EBITDA increases by 4% to 292 crores, translating to an EBITDA margin of 22%. Margin moderation reflects the impact of higher input costs. Profit after tax enhanced by 6% during the quarter to 230 crore, and for the half year enhanced by 15% to 417 crores. Balance sheet position further bolstered during the quarter based on strong performance momentum. The company generated positive operating cash flow of rupees 208 crores during the quarter FY22 and also maintained higher inventory levels to meet customer requirements to avoid supply chain disruptions. Before I close, let me quickly share some statistics around our capital expenditure. For the half year ended 30th September, we have entailed under rupees 168 crores of capital expenditure and remain on track to deploy further 105 crores for the remainder of the year. That concludes my opening commentary. I will now request the moderator to open the forum for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and one at this time. The first question is from the line of Ritesh Gupta from Kotak Institutional Equities. Please go ahead.
Yeah, hi sir. Thanks for taking my question. Just to one is on the pharma side. Now that INSWIFT is not happening, what's the plan in terms of the overall ramp up of the business? Do you still keep to your guidance that 20% of the business would be driven by pharma, let's say 4 years down the line? That's one. And the second one is that on this quarter we see an interesting thing that your gross margins have expanded despite all the RM inflation that you talk about even in the presentation, and partly maybe because of product mix. But other expenses also shot up materially. And is it largely an impact of power and fuel and logistics cost, or is there something else? So I think the question here is that have you passed it on fully as of now, or is there a scope for the margins to improve in the subsequent quarters? These are the two questions from my side.
Yeah. Good morning, everyone. So Ritesh, to your two questions. Number one, pharma. Pharma strategy of PI is twofold. One is what we are organically doing in-house. That remains, unhindered and intact. We are already progressing on several of these intermediates at our pilot scale and at different scale-up levels. That continues even for commercialization of those products where there is no need for GMP manufacturing facilities. We are already, in the process of commercialization, modification of plant and all that. So that continues the way it was planned. The second part is where we are requiring some GMP facilities, and therefore for that purpose we will surely be looking at other alternatives of inorganic opportunities. We are already in that process of shortlisting. There are several, opportunities in the market. We are evaluating them. In fact, we were looking at them, and we will soon kind of internally decide on what are the some of these opportunities fitting in our scheme of things, and accordingly work on them. And in the meantime, for shorter period, we can always look at outsourcing models to bridge the gap. So that is in nutshell, the overall approach on pharma. But we remain confident on our plans, on our scale up, and within next 4 years' time, our aspirations of achieving close to 20% or more than 20% of overall PI's revenue from this vertical remains intact. Your second question on gross margins. So yes, in the CSM space, we have seen increase in input cost across the products and even services and even fuel costs. We have seen rise in fuel costs from say 30 to 50%, or even more than 50%. So in many cases, there will always be lead and lag, in this price increase situation, input price increase situation, and in many products it is still continuing, raw materials. So yes, in many cases we have already passed through that and built in prices, and in many cases these things are still happening, discussions are happening and it's still happening. So yeah, this is the current situation. And we believe that with our understanding with these customers and global companies and our agreements and understandings, we shall be able to pass on these input costs to our customers and then optimize and maintain our margins. I hope I've answered both your questions.
Thank you. So the current participant has left the question queue. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Vishnu Kumar from Spark Capital. Please go ahead.
Thanks for the time. Just going back on the margin question again, we see that your EBITDA margin has come down. So is there any one-off sitting in your OPEX cost this time around?
Yeah, so actually it is the impact of both the fuel cost, which appears in, you see the overhead bucket. So there is a lot of fuel or utility cost and all that which is there. The inflationary impact of that is also reflecting there. And of course, there is one-off cost as well. Many of these strategic initiatives that we have taken over the last 1.5 years, 2 years, a lot of cost is also pertaining to those strategic initiatives and are of non-recurring nature.
Can you quantify that numbers or any non-recurring number?
Well, non-recurring would be, I think, 10 to 12 crore or something.
Something around this picture. Yes.
So the pharma strategy, you mentioned organically various parameters you mentioned. Is there any capex that you would require to set up plants, or until and unless you find an inorganic opportunity, would you go ahead and would you go ahead and invest in any multipurpose plants, or can you do it in your agrochemical facility? Some broader understanding on this organically, how you can scale it up, or what sort of revenues that you think can at least do on this side, if you could just help us understand.
Yeah, so wherever there is no requirement of GMP, yes, we can certainly, invest. We can modify some of these available white spaces and use them, which is what we are currently doing. We can also, add one multi-product plant where we can kind of manufacture many of these intermediates, on a multiple basis. So yes, I mean, that is very much part of our plan. And this will become part of our normal capex of, 300 odd crores every year that we have envisaged.
Okay. Any rough capex towards pharma organically that you're building in next year or this year, next year? And any revenues currently you're deriving from pharma at present?
Yeah, so around 75 odd crores is what we are anticipating at this moment.
This is capex, sir?
Which is mainly towards the modification of some of the white spaces that are available.
Any revenue you are deriving now, or maybe how much you expect to generate out of this 75 crores or next year or so?
Yeah, so I mean, although these are all part of now planning process that is still going on, but yeah, I mean, we would surely be in a mid to long term basis. We will be able to certainly generate, 1.5 to 1.75 multiple of the investment.
Understood, sir. Thanks and all the best, sir.
Thank you. The next question is a follow-up question from the line of Ritesh Gupta from Kotak Institutional Equities. Please go ahead.
Sorry, sir, my line got dropped. Just one other follow-up I had was on the domestic side. The domestic growth rates for some reasons has been fairly muted if I strip out Exagro acquisition and this growth. So could you just throw some light on, what could change? And I know that industry peers also haven't done well, but, what could change the future of the business and what could help you grow at 8-10% or 12% also over the next 3-4 years? And if you could just in key 1 or 2 points which led to this domestic growth rates to still be muted over the last 3, 4, 5 years.
Raman, would you like to take that?
Yeah. So thanks for that question. And as you rightly pointed out, I think this year, despite the monsoon starting off well, and then there was a fairly long disruption followed by continuous rain. So agriculture and the agchem industry in general has been pretty muted, and we expect at best flat to maybe low single-digit growth at best in the first half of the year. So in that particular context, given that we have had some supply issues from some of our key products from our global partners, which is related to various supply chain constraints that we are seeing globally, that really was one constraint that prevented us from growing more than what we have done at this point. I mean, we came in kind of flat in the domestic business. That's one key factor. So that's a one-time effect, and with a better planning, better communication, we are now adequately covered, with our global partners for the rest of the year and going forward. The second was there were specific issues in the market, for example, in Uttar Pradesh, which faced continuous rains for a long period of time. Our rice herbicide penetration was, dampened, and that's been an additional factor. So these were a couple of the key drivers for the muted growth that we have seen. Added to this, we had also planned a couple of new product launches, both on our Jivagro, the horticulture side, and also on the PI Agri side. And due to regulatory delays, that did not happen. So these are the three factors. But on the positive side, where we have not been able to sell because of market and weather conditions, we have proactively taken the product back. Sales return has happened. So we are starting off the Rabi season on a very sound note with less inventory of our products in the system. Also, we will be launching 2 new products in the next 3 to in the Rabi season. One is a rice insecticide, and another one is new biological fungicide for grapes, which is very unique because it does not have what is called as pre-harvest interval, so it can be applied all the way close to harvest, which is a great kind of a convenience that we will give to the consumers. And the third very positive aspect of our portfolio has been the wheat herbicide, which we launched about a couple of years. We are very, very happy with the kind of demand that we have seen. in the market and the liquidation that is happening as of now. So, to the short answer, the answer to your question about the confidence about future really depends on is on the basis of the blockbuster new molecules that we are planning. The very focused go-to-market approach that we have for the row crops, which is dominated by PI, and the horticulture crops dominated by our new go-to-market approach with Vivagro, combined with our digital and mechanization efforts. So these are the areas which will give us confidence that we will continue to drive growth well above the industry.
And also to further add that we also have a few products which are coming for new in the next coming years in the pipeline, which is also strong to give us this confidence of driving far above the industry. Yeah?
Got it, sir. That was very elaborate. So just to conclude, we expect Rabi season to be much better thanks to the pyroxasulfone launch in domestic market. Is that the correct understanding? And lean inventory in the channel that you might have had.
Yeah, and also the rice herbicide in the south, and the early kind of impact of the new molecules that we have.
Got it, sir. That's all of my questions, sir. Thank you so much.
Thank you. The next question is from the line of Aditya Jhawar from Investec Capital. Please go ahead.
Yeah, thanks for the opportunity. Sir, if you can, give us some sense on the capex intensity. So what we are seeing that capex intensity has been coming down quite sharply. Is it that because we are intending to, do some acquisition, so that is the reason that organic, capex has come down? So we understand that, our order book has come down from 1.5 to 1.4. We understand that there is a strategic reason that we don't want to commit more steel on the ground. So if you can directionally help us understand on the organic capex side, what is the thought process? That is the first question.
Yeah. So on capex front, there are 2 points, Aditya. One is that, as we have also explained in our previous calls, that over last 1.5 years, with the implementation of some of these, process innovations and also engineering technologies, we have been able to substantially improve the plant throughput, And this is precisely the reason that we would have also noted that current year we are commercializing 6 molecules, and still we have not invested very heavily in terms of building new plants. And so this is one key reason that you see less intensity. This has always been one of the key strategic objectives for us, that if we have to sustain the growth and more importantly, profitability in this CSM export, we will have to substantially improve our capital efficiency. And then I'm happy to share with you all that we have been, with intense efforts from our research and engineering teams, we have been able to, see the fruits now for last 1 year or so. So that is one reason that the capital...
I have to say that it really is very satisfying to see that how the investments in R&D and technology are yielding us these positive outcomes.
Yeah. Coming to second point, in terms of order book, yes, there is a marginal decline, but this is primarily coming from the current, pricing scenarios that we are seeing in the market. As you can imagine that input prices are swinging here and there, and in this kind of a, scenario, we found it really difficult to kind of, commit long-term prices and get into long-term agreements or something. And therefore, and particularly when I'm talking about price trends and all, I'm more talking about the fuel and other inputs which are part of conversion cost, not so much so on, raw material front, because that in any case is passed through generally. So because of the current scenario, we thought it is better to kind of wait and watch rather than, continue aggressively pushing for long-term agreement and order commitments and all that. So this is precisely the reason for this marginal decline.
Yes, thanks for the elaborate answer. My second question is, sir, on the gross margin again. Sir, we understand that there could be a favorable product mix change, but to better understand this, like there is an element of increase in share of revenue from the CSM business. But sir, within that, if you can help us understand that as the new molecules that we have commercialized the last few years, possibly they could be relatively higher stages of complex chemistry. Does that mean that as the newer molecule contribution revenue would increase, that margin trajectory will continue to improve? Some color on what essentially you mean by favorable product mix change.
Yeah, so there are two elements to it. One is, of course, the business, mix. So as you would have seen, the CSM export share has increased this year because of continued growth and little slower growth in domestic products and areas. So one is that reason, and the second is that since we commercialized, I think 6 to 7 products in last 1.5 years. I mean, those have also contributed in terms of improved margins. And obviously, as these products will scale up going forward, because in the initial couple of years, the volumes always are lower, relatively lower. But as these products will get registered in different countries, these are mostly new products. As these products will get registered in the newer geographies, the volumes will increase. Obviously, these will also contribute in terms of improved gross margins and profitability. Secondly, the scale will also increase, and that will also bring in the operating leverage, to the overall P&L. So yes, I mean, we expect that once these one-off kind of things are out, we see some stabilization in the input pricing, and we have also made the right, corrective measures on the pricing front due to this current wavering input prices. The margin should certainly improve.
Perfect. Thanks a lot, sir. That's it from my side. All the best.
Thank you.
Thank you. The next question is from the line of Surya Patra from Phillip Capital. Please go ahead.
Yeah, thank you for this opportunity, sir. My first question on the pharma side. Sir, obviously we have been working on the outsourcing opportunities as well as the intermediate manufacturing opportunities. But could you share something on the customer acquisition front? Why? Because we know that is the bigger challenge in the pharma, other than the capacity creation or capability build up.
I think that's a fair question. The customer acquisition side, once we've been able to establish the product and the technologies, we have a strategy to go out and work on those customers. We've already identified those areas. And from the intermediate side, there is a process of approval and regulatory requirements which may be required at different stages for different kind of products. Those are in plan. And that is what was the key thing of getting executed over the next 18 months, so that we see to go to the next step. Yeah.
Sure, sir. My second question is on, let's say you have mentioned about manufacturing, fructifying for one of the electronic chemical with the one leading global player. So can you talk something more about that opportunity that is the focus area? And did you, during this supply disruption, what we have been witnessing, did you find any major long-term supply contract from global customer side?
Yeah, so from the electronic chemicals, yes, we have got into the commercial manufacturing of the product. And as we continue to look ahead, we really are getting into a long-term areas where we are in the various stages of approvals. And we do believe that, yes, this is going to definitely land up in long-term contracts in the next couple of quarters, yeah.
Okay. So, sir, thank you. Wish you all the best.
And obviously, as you know, electronic chemicals is a new area where we see a huge potential, and we are working in those areas for now, yeah. So it's interesting and exciting part to us that we have got into the commercial manufacturing, met customer requirements and approvals there.
Okay. Sir, if you can just add on the even post-INSEP, our inorganic initiative having an experience with INSEP, are changes to our M&A strategy for pharma or something like that?
No, not at all. In fact, as we mentioned earlier, that approach, pharma strategy and our approach of expeditious scale-up remains the same. Okay? We will work on both the fronts. Organically, what we had planned and what we are doing, we are expeditiously progressing on that. And on inorganic front, again, as I said, we will surely maintain the same approach. We'll look at several options which are there in the market and quickly move forward on them.
Sure, sir. Thank you. All the best.
Thank you. The next question is from the line of Rohit Nagraj from MK Global. Please go ahead.
Yeah, thanks for the opportunity. Just delving on the earlier question on electronic chemicals, I understand this is a growth opportunity even from China perspective. So if you could just give us a little more color in terms of the opportunity size, are we directly approaching the OEMs, and whether it is a domestic-oriented business also which can be scaled up, eventually, because I think we are still dependent on imports of these electronic chemicals which are relatively high purity ones. That's the first question. Thank you.
Thanks. KVS, maybe you may want to respond to it. KVS?
Okay.
Hello?
I think for some reason we dropped off the line. Yeah, so obviously the electronic chemical opportunity is large, as these are small volume, high value, complex chemistry areas where there's a quick turnaround time. We clearly have our inroads with the credibilities in the markets of Japan and other parts of the world where we've been able to establish and make these entries. Having said these entries, we are working with the OEMs, which are in the chemical part of the business, and that's really we are working and looking to say that how do we, with step by step, go up to the value added to the end game, and that's really how we are taking this approach. And there's another vertical approach where, like we've been able to build over the years in the CSM, we're focusing in the in the electronic chemical area. Yeah.
Right. Got it. So the second question is, again, during your initial remarks and in the presentation, we have said that we have signed a technology partnership for a JV in biochemical space. So if you could just give a little more color on in terms of what is the space, how synergistic it is with our current R&D program, and in terms of opportunity size, what are we looking at over the next couple of years in terms of pilot and then scale up and commercialization? Thank you.
Yeah, so this will add to our portfolio of technology, basically, because so far our focus and effort of our existing resources and technologies was more on chemistry side, and this will bring in this newer area, biochemicals, which we can certainly leverage both on pharma side as well as on agrochemical side, and that is the whole plan. As mentioned earlier, we have entered into a joint venture arrangement with the technology partners. We are expecting to scale up these technologies and processes across pharma intermediates as well as some of these AgChem intermediates over next 12 months, 15 months time, and then we will be commercializing them. Whatever regulatory processes are also involved here will also be taken up with the respective customers, and then we will be commercializing these technologies.
Right, sir. That's helpful. Just one clarification in terms of pharma inorganic initiative, any timelines that we are looking at now?
Well, this is on tomorrow's basis. So that process is on and will continue. We will surely expeditiously working on that project.
Thank you so much and best of luck, sir.
Thank you.
Thank you. The next question is from the line of Hemant Kumar from Motilal Oswal. Please go ahead.
Yeah, hi, sir. So, can you talk about the growth in the new molecule we have launched in CSM in last 3-4 years? compared to the old chemistry what we have in the portfolio?
Sorry, come again. Growth?
So, say in H1 we have a 27% growth in CSM segment. So can you talk about the new molecule we have launched in last 3-4 years, the contribution, the growth contribution, and the old chemistry growth?
Well, we'll not have this number in front of us, but I can tell you that, for example, we did some assessment. Close to 17 to 18% of our revenue is coming from new products. Last 2-3 years assessment that we have done. So whatever products that we have launched in last 3-4 years, they are contributing close to 17 to 18% of revenue.
And I believe that after 3 to 4 years of launch, 4-5 years of launch, they accelerate.
And I believe this is going to be the trend for next several years, as we are also continuing to launch newer or commercialize newer products every year.
Okay. Talking about the Aurica, in the Rabi season, what is your expectation? What is the outlook in this Rabi season for the herbicide?
Raman, you may want to take this.
Yeah. So the expectation is that we would cover about 3x of the area that we had covered, more than 3x of the area that we had covered in the last year. And as we speak now, we are very, very happy with the progress that we have made. We are on a daily basis treating what we treated in the first year of its launch. So it's a very, very healthy progress, and the demand has been extremely good.
Thank you so much.
Thank you. The next question is from the line of Rohan Gupta from Edelweiss Securities. Please go ahead.
Hi, sir. Good morning, and thanks for the opportunity. Sir, a couple of questions. First is, sir, in last 2 to 3 years, our focus has been more on driving throughput with the limited capex, but we have seen a significant improvement in asset turnover. But definitely, sir, there is always a limitation on that. We have not been adding much on the gross or any larger investment has been made in any greenfield or plant. So, sir, with this limitation on further driving the throughput probably over next 2 to 3 years, what do you see that how much more asset turn we can generate, or how much the total turnover we can generate from our existing assets, and how much is for further brownfield expansion at our existing plants?
Yeah, thanks, Ron. So yes, you're right. As I was also telling earlier, for last more than 1.5 years, we have been putting focused efforts in this direction, and we have achieved great success. And that is the reason that for commercialization of several of these new products, we were not required to put in 4 or 5 plants. Otherwise, going by the previous phase, we would have invested at least in 3-4 plants. So that is one. Secondly, in terms of continued growth, your other question on what kind of turn that we can get, I am sure we can reach to 2.4, 2.5 turn kind of asset turn kind of figure in next 6 months, 1 year time, as we are still optimizing some of these throughput in some of these plants. So that process will continue and will give us a lot of efficiency advantage. In terms of our visibility for growth, that continues. We still maintain that we have close to 20% kind of growth visibility in the CSM scale-up and export. And our current R&D pipeline, the pace of commercialization of molecules, everything is giving us confidence and also supporting this confidence that we have on the scale-up and sustained growth. Anything you want to add?
Further, we continue to augment the investment in our resources in R&D in terms of human capital to manage more projects. One more dimension which you must keep in mind, that when we built a brownfield in 29, the larger part of the infrastructure capex is done. So the additional capex comes from capacity expansion, which may not be as substantial as we see at a certain peak at a point, and we still have potential of putting up a few multiple purpose plants, but with the back-end infrastructure is in place.
Yeah, because the common infrastructure is already invested, 3 years back, 2 years back.
Sir, extending on the main sir answers only on that. So you said that we still can put some more MPPs on our existing facilities and already covered with the infrastructure. Sir, on that only I want to elaborate a little, understand a little bit more elaboration in terms of how much money we can spend more on a brownfield, like 500, 700, 1,000 crore, because we definitely will be facing the issue of land availabilities and a basic infrastructure, because we are in chemical, so there is only restrictions on how much capacities we can add on our existing facility. So on a brownfield over next 2 years cumulative, how much investment these existing plants can absorb, sir?
Yeah, so first of all, we do not see any limitation of expansion per se, Like many industrial estates in different parts of the country, fortunately, we do not see that kind of a challenge in the industrial estate that we are operating, okay? Availability of land, disposal of effluent, these are the major reasons. Generally in the industrial estates where the expansion is restricted, we do not see these challenges in Jambusar where we are operating, okay? So that is one. Secondly, the currently available further land is also available, so that's not a challenge. But even in the available land, we can have another at least 2-3 multi-product plants. And as I said earlier, that the normal investment plans of 250 to 300 crores every year is what we can invest. Although lot will also while we will be planning and finalizing these plans, lot will also depend on what kind of inorganic opportunity we finally land in, because a lot of this capex will also reconfigure with that kind of asset and plan. But yeah, generally sitting today, we can say that close to 300 crores capex every year is what that we can plan to meet the capacity requirements, to meet the pipeline of commercialization products that we have.
Okay, that's pretty helpful. Just a last question. Sir, on our pharma business, definitely we must be very aggressively looking now any pharma asset. We had roughly 2,000 crore rupees raised from the QIP and has further added to that cash only because of the solid free cash flow generation. Sir, any thought process change in that, because now you are sitting on a much stronger balance sheet than earlier, almost 2,500 crore rupees cash further going to add there. So are you looking at much larger assets now, asset base, and even for the global acquisitions also you are open? So is there any change in thought process that now you are looking much larger scale, or it is similar you have looked at this?
Well, frankly speaking, size is not the criteria for for us to, or as a matter of fact, it was also not a limitation for us to look at something interesting which fits in our scheme of things. So we are absolutely open, whether it is a smaller size, relatively smaller size, or whether it is a larger size. I think the important is that what we will be able to do with that option in mid to long term is going to be the key criteria for us to go for that option, and we'll be certainly open to look at all kind of options, smaller, larger, variety of the revenue, variety of the assets, customer, products. So there are several critical aspects, and we will be open to look at various options.
And sir, would you be able to put any timeline on that, sir? I know it's very early, but
I responded to the earlier participant on this, that this is on yesterday basis. So we are working on this very expeditiously, and we'll see what best can be done.
Thanks, sir. Thank you so much, sir.
Thank you. The next question is from the line of S. Ramesh from Nirmal Bang. Please go ahead.
Hello, can you hear me?
Yes, please.
Yeah, good morning and thank you very much, and wish you all the best of seasons.
So the first thought is, so if you're looking at your the first MPP coming in second quarter and another MPP coming in third quarter, together what will be the asset capitalization, and can we assume an asset turn of 2x say by FY23 of these two MPPs?
Well, your audio was not very clear. It was breaking. So can you please repeat your last part of your question?
Yeah. So if you're looking at the two MPPs in the second quarter and third quarter, what is the amount of addition to the gross block on capitalization, and can we assume an asset turn of 2x on these, once they are in commercial operation?
So the capitalization is 168 crores during the first half of the current fiscal, and we expect the same asset turn will continue after the period of 6 months from capitalization.
Okay. And the second thought is, I just want to understand what are the lessons you may have learned from the business transfer arrangement you had with InSwift, and how do you envisage, overcoming whatever constraints you face in concluding that deal in whatever targets you're looking at in your current endeavor to make an acquisition in the API space?
Again, sorry, but your audio is breaking, not very clear.
Sorry, I just wanted to understand what are the lessons you have learned from the BTR you signed with InSwift, and had to be cancelled as a result of some of the preconditions not being met, and how are you preparing to ensure that this such a setback doesn't happen in a future acquisition?
Yeah, so I would say a lot of lessons. Obviously the preliminary assessment about the company, about the reputation, about value systems, and various aspects that are important to kind of assess in the very preliminary kind of evaluation. Those certainly need to be taken into account. And obviously, as we have also said earlier, that just because we have to expedite the process and expeditiously complete the process, we certainly cannot compromise on various vital necessities and critical aspects of a M&A. We would certainly want to get out of something rather than feeling sorry after the completion of the thing, and then kind of keep explaining things to our stakeholders. And that process, that approach will certainly continue. That yes, we have to expeditiously work on the inorganic thing, but without compromising on the value systems and governance and our approach of doing things.
Yeah, I appreciate your candid response to that. So one last thought, if you're looking at the specialty chemical space, is it possible to give us some number in terms of what is the target opportunity you're looking at, and what is the additional capex you may require in the next 2 years?
No, gentlemen, your audio is absolutely unclear.
Hello, can you hear me now?
Mr. Ramesh, we request you to please rejoin the question queue.
Can you hear me now? Hello?
Yeah, better.
Yeah, sorry. So I was just asking, if you're looking at the specialty chemicals opportunity, can you put a number to the kind of target market you're looking at in terms of revenue potential, and what are the kind of additional capex you may have to incur to achieve that, say, over the next 2 to 3 years?
Which for fine chemical you mean, for CSM?
Yeah, I'm talking about the CSM opportunity in specialty and fine chemicals, yeah.
Yeah, so this is what I answered to the earlier participant, that normally, 250 to 300 crore is the capex that we are envisaging in order to, build capacities and also meet the, R&D pipeline that we have, or the commercial product pipeline that we have.
Okay, fair enough. Thanks a lot, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Hi, sir. Thanks for taking my question. So one more question on the pharma business. Now, sir, fundamentally on the agrochemical business CRAMS, historically we focused only largely on the innovation part of the business, right? Working with innovators and doing custom synthesis. In pharma, even the ISL transaction was a buyout of a generic business. So why are we looking at pharma CRAMS, pharma opportunity in a different way that we pursued agricultural CRAMS in the past?
You get your question very clearly. Again,
the audio is not good at our end. I don't know whether it is for everyone or only for us. But I'll request moderator to please see if we can hear clearly. What is the question?
Sure, sir.
Let me try to rephrase it. Let me try if this works this time.
We are not able to hear your audio clearly. Maybe your question, phrasing is fine, but the audio is not. So maybe try again, please.
Sure. Yeah.
Mr. Agarwal, please proceed with your question. Please use the handset mode.
Hello. Raji, is this better?
Yes.
Okay. So I was saying, on the CRAMS business, historically when we pursued our agri CRAMS, we typically stuck to a approach of working with the innovators and working in the innovation value chain. But in pharma, are we adopting a different approach? Are we trying to participate in the generic value chain to start with and then sort of scale it up? So how are we looking at pharma CRAMS in a different way than the agri CRAMS?
So as you know, the pharma CRAMS business is slightly different the way the agri CRAMS works, right? So it is more asset and capability driven and credibility driven, which needs to be built through either structures of assets and generics, which we are looking at as an approach, and eventually going into that space with a longer strategy, which could be a much shorter and a faster way of doing that, whereas the generics and the CDMO approach works with the same organizations in many of these areas of the pharma CRAMS. Yeah. So that's the differentiated path to get there. With the Act, they're very different.
Yeah, I mean, just to also add that, it took us close to, or rather more than 2 decades to kind of get to the quality of CDMO that we are in today, okay, in AgChem space. And what we said that yes, I mean, we have to eventually get to the same level in pharma, but let's take a approach which can get us there maybe much faster, and which is where, while on one side we are working on technologies at our end, we have already kind of scaled up some of these technologies where we see a lot of potential in pharma. But in order to get access to the customer and also expedite this regulatory process of manufacturing asset and ABC, we are taking this inorganic approach, whereby we can start with maybe a generic kind of a model where we get access to the customer, the asset, the regulatory approval, and then eventually change the quality of revenue and quality of portfolio over a period of time. And in the end, we believe that this approach, this process will be much faster than what we have done in AgChem space. I hope this answers your question.
It does. If I can probably push in a little bit, probe that a little further. Sir, in pharma CRAMS, a generic to CRAMS evolution, I think that's been the standard model that most companies have tried to adopt, but we've seen that it's not been an easy transition for companies to make, largely because for a generic pharma business, you cater to a very different customer. And the CRAMS and the innovation CRAMS are very different set of customers altogether.
The difference, you are right, although the difference will be if you are a technology-based generic player or you are me too, one of the 20, 30, 40 players in those products. And we are certainly not aiming for the second one. We are aiming for the first one, where we have our differentiated technology, which will be the key driver for us to engage with these customers with existing products, and then eventually gradually get into more value added and patented molecules with same or different set of customers. But yeah, it has to be driven and backed by differentiated technology. This is the difference we are talking about.
Got it, sir. So if I can probably just push it last bit on this one. So when you say differentiated as a technology platform, I mean, if you can very qualitatively explain, I mean, how you explain thinking about that differentiation?
Yeah, I mean, I certainly cannot talk about those technologies here, but point is that one is that, just to explain you the difference, that there is X product and there are already 15 suppliers, and there is maybe a temporary vacuum in the market because of this global supply chain challenges, and we kind of build a capacity and we start manufacturing and supplying that product. This is whatever is the current process of technology which is available for all these 15 is one scenario. The other scenario is that you have done some process innovation, and with this process innovation, you are coming up with a completely different approach of manufacturing the same product, which gives either the sustainable model from environment or safety perspective, or it gives a completely different cost leadership. And therefore, you have created a differentiated approach or technology to manufacture the same product. So obviously these global leading players who are also now more and more inclined towards the ESG aspect of the business are keen on adopting and also aligning with the manufacturer who come up with such innovative and differentiated approaches of manufacturing these even generic products.
Got it, sir. Thanks. That's very helpful. Thank you very much.
Thank you. The next question is from the line of Bharat Shah from ASK Investments. Please go ahead.
Yeah, hi. If we take into account our portfolio of strengths, which is basically complex chemistry, research, long-term view of the business, technology related to the chemistry activities, and strong client relationship. If we look at the next 5-year target of superior growth, which is something that we have articulated again and again, both keeping in mind these trends, would you regard is areas that delight you and make you feel good about it, and what are still the areas which probably are chinks in the armor, or if not chinks in the armor, are areas which need still significant addressing to be done in order to achieve our vision of the long term?
So thank you for that question. I think it's an interesting question. I think we do believe those are our core strengths, and we have done and depicted and shown our performance in those areas in the AgChem space. And we definitely need to constantly keep evolving and moving ahead and building capabilities to create further attractiveness and in different areas of application. As a matter of fact, we have proactively, already over the last couple of years, proactively invested in the front end of the markets, like in Japan. We've added resources, capabilities coming from the pharma, the fine chemical space, and building the customer base. Obviously, the deeper insights have not been set up, as you would see. The whole challenge has been there in building that whole relationship. On the other hand, other parts of the globe, we started to build those relationships in those two areas by investing in them, by putting resources on the back end. I think technology is, if that is our core and that is our love, we constantly need to expand that horizon because they're constantly evolving and constantly changing, and we need to open new horizons. And as you would see through our strategy, we've been constantly doing that. And technology, again, as you know well, at least in the chemical industry, at least when you look at innovation, is a 3 to 4 to 5 year game before you actually can, from concept to really putting it to work, and a 10-year to 15, 20-year game after to make it really value created. And that's really where we are. And we're deepening this by the technology capabilities to create a further deeper, stickier relationships. And that is going to be answered by innovation. And that's the area that we have already, as you would see, crossed 100 patents, which gives opportunities to create a little more stickiness and is embed into the customer mindset, our capabilities from technology front, and the value commitment which you have is obviously something which the customer appreciates while partnering with innovation. So that's where we are.
And would it be fair to say at one point of time, probably we considered ourselves as agrochem specialty firm, research-driven, of course, but primarily an agrochem kind of a firm. Is that a subtle but clear shift in the mind that basically complex and innovative chemistry is our calling card, and over a period of time, that is what we need to achieve as a larger objective?
Right, so I would not say yes. That was not as a new vertical, the second engine. Our first engine of agrochemical is our strength and continues to grow our strength, and we are leveraging that to create the next play and challenging at a global level of challenging innovation and new products, and continuing to make sure that becomes an engine by itself, while the platforms are being put into the second engine. So clearly the technological research capabilities are the core competencies which were there, which are probably the world has seen it applied within AgChem. Now we are applying it in other areas. But doesn't mean that AgChem we are not going deeper down the value chain from all the way back to research.
No. And just to retread on the first question, any areas of concern, while there are considerable areas of strength which we have demonstrated, any niggling concerns, any worry, something which is still work in progress and we are not clear whether we have crossed the hump, anything that you think needs to be thrown light upon?
So as you would appreciate, when you're challenging technology, you're always standing on your toes, right? Because innovation technology is always a path which you take, which is a high risk with a high return gain. But in order to mitigate that, so there are many challenges and risks we see. In order to mitigate that, we have opened multiple frontiers. So at least even if a few succeed, we have achieved the objective which we actually laid out to play. And that's really how we work with it. So the idea here is, how do we differentiate and how do we mitigate but achieve the path of innovation and technology in order to deliver what we call the long-term sustainable growth for the knowledge and value add.
No, thank you, Mayank. All the best to you and the entire PI team.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
So thank you everybody for taking the time out on the weekend to be here to participate with the PI management, and wishing you all and your family a good weekend. Thank you. Bye-bye.
Thank you. Ladies and gentlemen, on behalf of PI Industries Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.